You walked into the pitch confident. The deck was polished. The projections were optimistic. The story was compelling. You were certain the capital would follow. And then it didn't. No term sheet, no second meeting, no clear explanation beyond, "We'll pass for now." If you've ever wondered what actually killed your deal in credit committee, this is the conversation most investors will never have with you directly. Because funding is rarely rejected for the reason you think. It's not usually about market size. It's not about how hard you're working, and it's almost never about whether your idea is interesting. Deals are rejected because of structural red flags that investors see immediately, but rarely articulate clearly. The first red flag is that you sold vision instead of risk. Most founders pitch opportunity. Investors underwrite exposure. Entrepreneurs are wired for upside. Capital is wired for downside. When an investor reviews your proposal, they are not asking how big this could become. They are asking how this could fail and how they get their money back if it does. If your presentation focuses heavily on growth curves, total addressable market, and 5-year projections, but lightly on risk mitigation, contingency planning, and capital protection, you've already created imbalance. Investors immediately begin running silent scenarios in their heads. What happens if revenue comes in 30% lower? What if costs rise? What if timelines slip? What collateral protects the investment? Where is the defensive layer? If those answers are not embedded into your structure, the deal feels speculative. Capital does not fund potential. It funds controlled risk. The second red flag is capital stack misalignment. Every layer of capital has a risk tolerance and an expectation. Senior debt expects stability and predictable cash flow. Mezzanine expects visibility and a defined path to repayment. Equity expects scalable upside and liquidity. When you approach senior lenders with early-stage construction risk and no pre-sales, you create mismatch. When you offer equity investors capped returns with limited upside, you create mismatch. When you ask for unsecured capital without institutional-grade reporting, you create mismatch. Investors rarely say, "You are approaching the wrong tier of capital." They simply say, "They don't have appetite." What they mean is that the risk profile of your deal does not match the return profile of their mandate. Funding is not about who you know. It is about whether your risk stage aligns with the capital you're seeking. The third red flag is a financial model that hasn't been stress tested. Many founders believe having a model is enough. It isn't. A model that only works under perfect conditions is not a model. It's a projection of hope. Institutional investors immediately stress numbers. They reduce revenue assumptions. They increase costs. They extend timelines. They adjust interest rates. Then they watch what breaks. If your debt service coverage disappears under moderate pressure, if your IRR collapses with small revenue variance, or if your working capital evaporates under delay, the deal is perceived as fragile. Fragility equals elevated risk. Elevated risk requires elevated return. If the return doesn't justify the fragility, rejection follows quietly. Investors will not explain their stress scenarios. They will simply conclude the resilience isn't there. The fourth red flag is a vague or imagined exit strategy. Every investor enters with an exit in mind. Debt investors want repayment certainty. Equity investors want liquidity. If your exit narrative sounds like, "We'll refinance when we grow," or "We'll sell to a strategic buyer," or "We'll go public eventually," you have not defined an exit. You've described a possibility. A credible exit strategy is milestone-driven. It answers when, how, under what valuation metric, and through which mechanism capital returns. It connects operational milestones to liquidity triggers. If you cannot clearly articulate that path, investors assume indefinite capital lockup. Indefinite lockup increases perceived risk. And when risk perception rises, capital either becomes expensive or disappears. The fifth red flag is going to market too early. Many founders approach investors when they need money urgently. That urgency is visible. If permits are incomplete, contracts are unsigned, land is unsecured, legal structure is evolving, or the team is not finalized, you are early. Capital punishes early-stage uncertainty unless the return profile is structured accordingly. But even more importantly, premature market exposure creates reputational memory. When you present an underdeveloped deal to institutional investors, they form an impression. If you return later with a stronger structure, you are no longer new. You are the deal that didn't close. Markets remember. Sophisticated sponsors understand that timing is strategic. Sometimes the correct move is preparation, not pitching. Beyond structure, there is a psychological layer most founders underestimate. Investors evaluate operators as much as assets. During questioning, they observe composure. They test consistency. They probe weak assumptions deliberately. If you become defensive, evasive, or overly promotional under scrutiny, trust erodes. Trust is not built through enthusiasm. It is built through clarity, realism, and balanced confidence. Investors ask themselves one quiet question. If conditions deteriorate, do we trust this team to respond rationally? If the answer is uncertain, capital withdraws, regardless of how attractive the spreadsheet appears. Another hidden factor is incentive misalignment. Investors analyze whether your downside exposure matches theirs. If you have minimal capital at risk while seeking significant investor capital, that imbalance is noticed. If your compensation structure rewards you before performance milestones are achieved, that is noticed. Alignment reduces perceived agency risk. Misalignment increases it. Even if never verbalized, it weighs heavily in decision-making. You may wonder why investors rarely tell you these real reasons. Transparency creates negotiation. Detailed feedback invites debate. And blunt honesty can damage relationships. It's simpler and safer to say, "not aligned with our mandate," or "timing isn't right." These phrases conceal structural concerns without opening confrontation. You are not being misled, you are being filtered. Capital markets operate on efficiency. If foundational issues exist, investors prefer to step aside quietly rather than re-engineer your deal for you. If your funding was rejected, the instinct is to move quickly to the next investor. That is usually the wrong move. Repetition without correction simply multiplies rejection. Instead, pause and reassess structurally. Have you clearly identified and mitigated downside risk? Is your capital request aligned with the correct risk tier? Has your financial model been stress-tested under conservative scenarios? Is your exit engineered or merely imagined? Are you truly market-ready, or are you seeking validation? Fundability is not about persuasion. It is about preparation. Capital is mathematical before it is emotional. It is defensive before it is opportunistic. It rewards structure more than storytelling. The harsh reality is that funding rejection is rarely about your intelligence or effort. It is about architecture. Deals do not fail in the pitch room. They fail in the structure long before they are presented. When you understand the red flags investors see immediately and correct them before re-entering the market, you shift from hopeful to fundable. Most sponsors believe access is the key advantage. In reality, execution is. Relationships do not override underwriting. Optimism does not replace resilience. And vision does not substitute for risk management. If you want a different outcome in your next raise, do not refine the pitch first. Refine the structure. When the structure is sound, capital conversations change. Rejection becomes negotiation, and negotiation becomes terms. Funding is not won through intensity. It is won through alignment. If this analysis resonates with you and you are preparing to approach capital again, do not go back to market blindly. Subscribe to this channel for deeper breakdowns on how capital actually thinks. Share this video with a partner or co-founder who needs to hear it. And if you want a serious evaluation of your structure before your next raise, reach out and have the deal reviewed properly before it reaches credit committee. The difference between rejection and terms is rarely charisma. It is preparation.